What if I tell you you can partially own these popular shopping malls or other business properties that give you consistent dividends that beats your typical fixed deposits and all those money market funds, all without needing a large amount of cash upfront? Yes, this is made possible with REITs, short for Real Estate Investment Trust, that you can trade through Bursa Malaysia. But how exactly do they work? What should you be aware of? Is it still a relevant investment in 2025? Are they really better than any other investments and dividends from bank stocks? This is your ultimate guide to REITs, which my team and I have spent tons of hours for research. So without further ado, let's dive right into it. So here's how REITs really work. I know this image might seem very overwhelming, so let me simplify it for you. Imagine it like a piggy bank where people like you and me put our money together to buy properties. Then, the manager, which is the REIT management company, buys all these places like malls, hospitals, offices and warehouses and then rents them out. And most of the rental profit, usually at least 90% of them, are all shared among all of us investors. And that's where you as a REIT investor gets your passive income or dividends. So what is so special about that 90%? You see, when REITs distribute 90% of its total income to investors like us, they get to enjoy tax-free status, which also means they can deduct whatever they pay to their shareholders from its corporate taxable income. And that is why REITs in Malaysia usually pay out 90% of their total income. So in a way, your dividends from REITs are kind of guaranteed, and that explains the attractive 7 to 8% dividend yield from the top 4 Malaysian REITs. As for individual level taxation, you will only be taxed at 2% if your total dividend income is more than 100k for the whole year. Anything less than that, you will not be taxed. And before you ask, this video is made in collaboration with Moomoo Malaysia, and with the Moomoo app, you can trade global REITs in just one account with very minimal fees. If you haven't signed up yet, they are now offering attractive sign-up rewards for new users, including free shares. Latest details in the pinned comment down below for you. You can click into my link down there, and that was it with my exclusive code Z11, that's Z11, to get extra rewards before the campaign ends. Now, as of the recording of this video, there are a total of 20 listed REITs under Bursa Malaysia, and you can find the full list in your Moomoo app by just typing REITs and choose the MY list, and here you go, you have full list of REITs available in Bursa Malaysia and everything you need to know about the particular REIT, like dividend yield, payout ratio, dividend frequency, dividend growth rate, and even their 5-year average yield. And they even have a record of all the past dividend payouts, so this is a very good reference for you. And from this list of 20 REITs, they are categorized into retail, office, industrial and logistics, hospitality, and also, of course, healthcare. Now, how do you buy a REIT? Well, it is exactly like how you buy and sell a stock on Bursa Malaysia or just any other stock exchanges. And because REITs are liquid, meaning a lot of people trade them on the stock exchange, you can just sell it anytime if, let's say, you change your mind about the investment. And unlike buying physical properties like a house or a condo, you don't have to wait for months or even years before you even find the right buyer, so you can get back your cash immediately if you need them. The best part is that it's totally hassle-free. You don't have to deal with tenants or maintenance. Just really sit back and enjoy the quarterly dividends. Now, before you ask, I've compiled Malaysia's top 8 REITs by popularity and also their annualized return over the recent years. So feel free to take a screenshot and check it out later. But of course, just like any other investments, REITs do have their fair share of risk as well, which we'll talk more about it later. But now, how do REITs differ from other investment instruments like stocks, money market funds, US Treasury bonds, fixed deposits, and savings accounts? Well, I've prepared for you a comparison table. But before that, I realized that more than 80% of you watching this video are not subscribed to this channel yet. Making these videos take a lot of effort and time, so if you enjoy these investing contents, you'll help my team and I a lot by just clicking the subscribe button down below. We promise to deliver more and better research videos for you in the future. And just FYI, the REITs chosen here are those with one of the highest dividend yields, but that doesn't mean they are the best REIT pick because there are still many factors at play. But regardless of that, REITs still stand out to be one of the most attractive ones compared to other investments and the overall stock market as of the first quarter of this year. And I know there are many stocks that perform well during the past 6 months, and if you invest in those stocks, they offer higher capital growth. But again, that depends on your risk appetite. If you can tolerate high risk and do not just want to settle with just stable dividends, by all means, go for stocks. But if you are someone looking for reliable passive income, REITs offer a balanced approach as it delivers consistent dividend yields with moderate capital appreciation potential. And as for money market funds, bonds, fixed deposits and savings accounts, they are in general lower in risk, safer but give you lower returns in the range of 2 to 4% per annum, which honestly sometimes can't even beat inflation. So for those prioritizing consistent income streams without excessive volatility, REITs are arguably one of the best options, blending income stability with moderate capital growth. And I know you might argue that banking stocks have similar characteristics as well. Well, you are not wrong, and that's why I have prepared another table for you. From a glance of it, yes, these banking stocks traded under Bursa Malaysia also give quite a high dividend yield. But remember the tax-free benefit that I mentioned earlier? Banks do not have these benefits, so in a way, they are not as motivated to pay out huge dividends, which means your bank dividends are not as guaranteed as those of REITs. And one more thing to take note, as much as all stocks are somehow affected by the economy, the banking stocks do get affected more than the REITs. You see, your investment return consists of two components, not just dividend income, but also capital gains. Just look at this, in the first quarter this year, yes, banking stocks gave solid dividends, but their share prices, overall returns suffered badly after OPR cuts as compared to the REITs. So if you're really looking for a stable passive income without risking your capital too much, REITs are a clear win over here. Anyways, if you are still looking for both capital gains and also stable dividend income from REITs, that's not actually impossible. Our neighbour Singapore's REITs, or short for S-REITs, are known for strong capital appreciation potential. Key reason behind this is because Singaporean REITs often own properties in prime and high demand locations such as Singapore's Central Business District (CBD), Marina Bay and Orchard Road, which leads to steady and significant capital appreciation. And also, Singapore has limited land supply and is strictly controlled by the government. Hence, the existing property's value will appreciate sustainably over time. And therefore, the choice between Malaysian and Singaporean REITs depends on whether you prioritize higher dividend income, then go for Malaysian REITs, or stronger capital appreciation potential, then by all means go for the Singaporean REITs. And if you're thinking how to invest in the Singaporean REITs, don't worry, you don't need a separate account. With the same Moomoo account, you can already trade all of them. Simply go to Market, choose SG, and you can start investing in Singaporean REITs. Now, as I've mentioned earlier, like all other investments, REITs have their fair share of risk as well. One of the factors that we can't run away from is interest rate risk. For example, if Bank Negara Malaysia raises the interest rate or OPR, that will also mean higher borrowing costs for businesses, which in turn means lower profit for the REITs. But in the case of recent announcements, which can also be found via the Moomoo app, lowered OPR means lower interest expense, which equals better return for all the shareholders. And of course, occupancy rate that ties closely with economic conditions. For example, back in COVID-19, reduced consumer spending and business activity led to lower demand for commercial properties, and as a result, rental income was badly affected. Many REITs were even forced to give rebates to all their tenants, and even then, most of the tenants did not survive and were forced to terminate their leases. And guess who's the ultimate loser? Is the REITs company behind those shopping malls and also commercial buildings. And like normal properties, the performance of REITs is closely tied to the property market cycles. oversupply or a slowdown in the property market can lead to reduced rental yields and also property valuations, impacting their final returns. And on the other hand, if the property market is doing good, the property becomes more valuable, and this increase in value will be reflected in their income statement under the net investment income. So in a way, as a shareholder, you don't benefit only from rental income, but also from how much the property value has increased. And one more thing that most people would probably overlook is the private placement announcement made by the company, which again can also be found in the Moomoo app. A private placement usually happens when a company's gearing ratio, aka their debt to equity ratio, has almost reached their 50% gearing limit set by the authority, and it is too risky to continue borrowing from the bank. And this is where a company goes for private placement, where money is pumped in by private investors or institutional investors. And when this happens, the total number of shares outstanding in the company will increase, and this is what we also call it as share dilution. Imagine this, same amount of profit to be shared by more shareholders now. Yes, you will receive a smaller portion, but if you think of it from a long-term perspective, these fresh funds, if used effectively, can bring in more growth for the company and hence better profit for the long run. And on top of all these factors, there are also metrics that you can look into, such as operation efficiency, net margin, EPS, etc, etc. And all this in-depth analysis can also be found on the Moomoo app. And you can also check out their news and community features to see what the investor sentiments are. Not to follow blindly, but it can be a great place to trigger some critical thinking in you. Now, the big question, are REITs suitable for everyone? Well, as much as I hate to say it, it depends on your risk tolerance and financial goals. If you value stable passive income above capital appreciation while taking relatively lower risk compared to individual stocks, then REITs might just be the right choice for you. So, if you haven't explored or added REITs into your portfolio yet, maybe it's time for you to give it a try. Let me know whether you would or would not go for REITs. In the meantime, if you haven't signed up yet, they are now giving away lots of cash coupons and also free shares. So deposit now using my exclusive code Z11 to get extra rewards before the campaign ends. Thanks for watching.